Imagine this for a second. You're flying down the highway at nearly 120 miles per hour. Everything feels normal. The engine is screaming, the road is blurring past, and suddenly, your speedometer crashes to zero. But the car doesn't stop. The engine is still roaring. You're still moving at full speed. Only the gauge died. That's exactly what's happening to silver prices right now. This Tuesday morning, February 17th, screens across the world are flashing around $75.50, and I know some of you barely slept after watching that drop. Some of you probably opened your apps 3 or 4 times during the night just to check if things got worse. But let me be straight with you. That number you're staring at, it's almost meaningless this week. It's like seeing a giant sale banner outside a supermarket, rushing in to grab the discount, and realizing every shelf inside is completely empty. The price looks cheap, but the product simply isn't there. And here's why. For this entire week, the biggest physical referee in the precious metals market, the Shanghai Gold Exchange, is closed for holiday. And when the referee leaves the field, chaos begins. The Western trading machines, the high-speed algorithms running on Wall Street and in London, start doing whatever they want. No discipline, no balance, no real physical buyers stepping in to stabilize price. This week, the physical market lost its referee. And when that happens, price disconnects from reality. So right now, I want you to do something important. Stop refreshing your portfolio app. Stop calculating losses in your head. Stop watching red candles flicker on your screen. Because what matters isn't happening on the screen. It's happening inside the vaults. And that's where we're going. Before we get into the numbers, though, tell me something. Where are you watching this from? Sitting at work pretending to focus? Hiding in your car during lunch? Watching from home late at night? Drop it in the comments. Because right now it feels like the entire retail investor crowd is sitting through this madness together. Now let's open this thing up and see what actually happened. When people see silver drop violently, the natural reaction is to look for a human cause. Someone must be selling, right? Maybe a mining company dumped supply. Maybe some billionaire liquidated holdings. Maybe industrial demand collapsed. But the answer is none of that. If you zoom into the trade data, especially during the sharp drop late last week and into Monday's session, something becomes very clear. This wasn't humans trading. This was machines. Cold, emotionless, automated selling triggered by algorithms. And to understand what happened, you need to understand something called a liquidity vacuum. Picture the silver market like a crowded room. Normally, buyers and sellers are everywhere. Physical demand from Asia on one side, Western futures traders on the other. Orders flow constantly, and when someone sells, someone else steps in to buy. Price stays relatively stable because liquidity is deep. But this week, half the room left. Shanghai, the world's biggest hub for physical buying, is on holiday. The real buyers, the ones who actually take delivery to build electronics, solar panels, defense systems, they're not at their desks. So liquidity disappears. And when liquidity disappears, predators show up. The drop to $75 wasn't some grand economic shift. It was a cascade. Here's how the trap works. First, an algorithm pushes price slightly lower with a relatively small sell order. Normally, that would get absorbed easily. But in thin holiday trading, price slips. And that's where retail investors get caught. Because once price touches stop-loss levels, automatic sell orders trigger. Those protective stops instantly turn into market sells, which pushes price down more, which triggers the next layer of stop losses. And suddenly, selling feeds on itself. A domino chain reaction. We saw a preview of this just days ago when silver dropped nearly 10% in minutes. Think about that. A strategic global metal suddenly losing 10% of its value in a few hundred seconds. Did humanity suddenly decide silver became useless? Of course not. A machine triggered a loop. And that loop has almost nothing to do with real supply and demand. But here's where the story flips. Because while price looked weak, something very strange was happening behind the scenes. Inside the COMEX vault system, the warehouses backing paper silver contracts, inventories weren't rising. They were falling. And that's the opposite of what should happen. Normally, when price crashes, inventory builds up because people are selling. But during this sell-off, registered silver inventory actually shrank. Millions of ounces disappeared from deliverable supply even as price dropped. Let me repeat that clearly. Price falls, but physical metal leaves the vaults. Registered COMEX inventory dropped from around 98 million ounces to roughly 92 million ounces in just days. That's not normal behavior. That's a divergence. It tells you the people selling paper contracts are not the same people removing physical metal. And if withdrawals continue at this pace, vault supply mathematically trends toward critical levels within months. Which brings up a crucial question. If you're a big bullion bank and you know vault supply is shrinking, and you know Asian buyers will return from holiday soon with massive demand, what do? You don't let price rise. You smash it lower. You scare weak holders into selling. You trigger stops, and then quietly take the other side of the trade. In other words, this drop looks less like panic and more like accumulation, a shakeout before physical demand returns. And remember, the algorithm isn't malfunctioning. It's doing exactly what it was built to do. Transfer assets from impatient traders to long-term players. Move silver from nervous hands into strategic ones. And while traders argue on social media, the vault keeps draining quietly in the background. Price is just the billboard. Inventory is the warehouse. And right now, trucks are leaving the warehouse every night. Imagine a shop owner claiming nobody wants his product anymore. But every night trucks show up and haul inventory away. You'd know something doesn't add up. And that's exactly the situation unfolding in silver. While charts scream sell, physical supply keeps disappearing. And this disconnect can't last forever, because eventually reality wins. And in part 2, we're going to leave the trading screens completely behind and step into the real world. Factories, solar energy, military demand, electric vehicles, the industries that consume silver no matter what price charts say. And once you see what's happening there, this entire price drop will look very different. So now, let's step completely away from the flashing charts, trading desks, and algorithm-driven price swings. Because markets can lie. Physics cannot. In the real world, outside financial casinos, silver isn't a ticker symbol. It's a physical necessity. And right now, demand for that necessity is exploding. Think about where we are in 2026. Every country is racing to secure energy independence. Governments aren't just talking about renewables anymore. They're building them at record speed. Massive solar farms are going up across deserts, rooftops, and industrial zones worldwide. And every single solar panel depends on silver. Not optional. Required. Engineers don't wake up in the morning wondering what COMEX price closed at. They wake up asking how many panels need to be produced this month. If silver gets cheaper, they don't slow down purchases. They accelerate them. Cheaper prices simply allow manufacturers to lock in more supply faster. That's what economists call inelastic demand. If luxury handbags double in price, people buy fewer. But silver isn't a luxury. Silver is infrastructure. It's closer to gasoline. When gas prices rise, people still drive to work. And when prices fall, they fill the tank and stock up. The same thing is happening now. Industrial buyers are quietly grabbing metal while traders panic. Look at electric vehicles, data centers, military electronics, and advanced computing systems. These industries don't function without high conductivity metals. And silver is the best conductor humanity has. There isn't a substitute that performs the same way at scale. Electric vehicles, AI servers, defense hardware, satellites, missiles, all of them consume silver in circuitry and components. And unlike gold stored in vaults, industrial silver is often destroyed in the process. Once it's inside electronics or weapons systems, it's gone. Not economically recoverable. Permanently removed from supply. So here's the contradiction unfolding right now. Industry is burning through silver. War and technology are consuming silver. Solar installations are demanding silver. Yet paper markets are temporarily pushing prices down. That disconnect cannot continue forever. At some point, physical shortage overrides paper pricing. And the big financial institutions already see this coming. Look at recent forecasts from major banks projecting massive upside for gold over the next couple of years. And historically, when gold runs, silver moves even more aggressively. If gold explodes higher in the coming cycle, silver doesn't quietly stay behind. It catches up violently, which makes today's panic selling look like noise in hindsight. And here's the psychological trap playing out. Banks and trading desks understand investor behavior perfectly. During thin trading periods like this holiday week, they allow algorithms to shake markets violently. Stops trigger. Fear spreads. Retail traders sell. Then those same institutions accumulate quietly while sentiment is broken. Later, when prices recover, the same metal gets sold back to the public at much higher levels. It's not conspiracy, it's strategy. And right now, physical supply trends suggest pressure is building under the surface. Which brings us to the rest of this week. You really only have two choices as an investor. Choice 1, panic. You stare at red candles, stress builds, and eventually you dump positions into algorithmic weakness. Exactly what the machines are waiting for. Or choice 2, zoom out. Treat this volatility as noise. Because what we're seeing right now looks less like a collapse and more like a temporary tantrum caused by thin liquidity. Imagine a drunk robot trying to walk straight. It stumbles, sways, crashes into walls, but eventually gravity wins and it falls over. That's what unsupervised algorithm trading looks like when physical buyers are away. And next week, those buyers return. When Shanghai reopens and arbitrage flows resume, price will once again be forced to reflect physical demand. The adults come back into the room, and that's usually when markets sober up quickly. So if you have cash ready and believe in long-term fundamentals, moments like this look more like clearance sales than disasters. And if you're already fully invested, sometimes the smartest move is doing nothing at all. Go outside. Spend time with family. Stop watching every tick. Because when you come back, silver will still obey the same laws of supply, demand, and physics. The short-term noise doesn't change long-term reality. Next week, when physical markets fully wake up again, we'll see whether this price action was a shakeout or something bigger. And when that moment arrives, we'll be here breaking it down piece by piece. So tell me in the comments, are you buying this dip, holding tight, or just grabbing popcorn and watching the chaos unfold? Until next time, keep your ounces close, tune out the noise, and stay safe out there.